this is almost like the agencies, Fannie Mae and Freddie Mac, are in cahoots with the banks because they don't want people refinancing too quick so the banks can make their interest on the loans that they funded in this high rate environment, because they're like disincentivizing refinances. And we know values have come up. We know, over the past several years, average credit scores on mortgages have been continually going up. Who's getting penalized? Lower loan to value, meaning values are appreciating, and higher credit score people, which is insane.
Yeah. So it adds a whole nother layer.
Welcome to Loans Elevated, the podcast that brings you the latest industry news, expert interviews, and insightful discussions that will help you stay ahead in this dynamic market. I'm your host, Broch Lassig, and I've spent years in the trenches of the mortgage industry, helping individuals and businesses navigate the complex landscape of real estate financing.
I'm your co-host, TJ Heidenreich, and together we'll cover a wide range of topics, from business strategies that skyrocket your success to mindset and motivation that fuel your growth.
We are on air.
All right. Kay, welcome to the podcast again, everybody. Thank you for joining us. We've got Ryan here, and it's going to be a better, more uplifting version with Ryan on. So,
got my positive pants on today.
Yeah, positive shorts on.
Yeah.
Yes. So today we're talking about something that's a big deal, obviously, and will become a bigger deal as time goes on, which is refinancing and what should be the strategy. When does it make sense to refinance? What information should you know before you make decisions on refinancing? So, Ryan, maybe give, what has your experience recently been with clients that are already jumping at the idea of a refinance?
Yeah, I mean, I think it's tough to not see the media and the news that is coming out with positive news over the last, it's been about a month, and not be intrigued and think that it's the right time to refinance. But there's so much more context that goes into it. And just like when you buy, there are so many factors that go into calculating your interest rate. It's the same thing on a refinance. So my thought is, just because you see a news article that says rates are somewhere in the mid sixes, I think right now they're saying 6.49 is the current weekly average. That does not mean that's where you're going to be. So it definitely makes sense to be curious, reach out. We, of course, want to be that advocate for you.
Well, and the crazy thing is, I want to chime in on there, that average weekly rate, so you guys know, that is what the news is reporting on. Yeah, so it's 2 weeks behind. The news is not reporting on, calling a mortgage lender, getting an actual bid, so on and so forth. This is aggregated data. Now, granted, these are actual bids from real-life mortgages. However, what we've noticed from an industry standpoint, which is very interesting because this is an average rate offering, is we've noticed virtually every one of our competitors, because rates have been high, and coming from the people that talk to clients and referral partners, realtors, builders, and things about mortgage rates, coming from our mouth, we can tell you for sure, because we experience this is all we deal with day in, day out. It's somewhat uncomfortable having the conversations about rates that are high. It sucks to say you've got, the rates are moving so much, I won't even say a number, but a rate that is significant. We've been talking about rates in the 7s at one point, maybe even quoting rates in the 8s.
Yeah.
And certainly still quoting some rates in the 7s down into the 6s now. It sounds high, but what our competitors are doing, which has been a significant shift over the past 2 years, slow but certain shift, they're quoting rates like you call and say, what's your rate? Well, there's no one answer to that, because the rate sheet goes from 5.5% to 10.5%. So there's not a rate, and they're in 1/8 of a percent or 1/16 of a percent rate. So we're talking 100 different rate options. So there's not a rate, but commonly clients or realtors or whoever will call and ask a lender, what's their rate? Lenders, the answer to that is a rate with very significant rate buy downs. Or another example here locally are billboards.
Yeah.
And they're charging 2-3 points, and that's the going rate.
When they send letters like crazy too, there are still refi shops out there. That's
right.
Their ultimate goal, especially a lot of the big name servicing companies.
Huge servicing companies,
name any, but
they'll charge these big.
Yeah, their whole strategy is sending these letters saying you're eligible to save money, and they'll throw in some ridiculously low rate in there that's almost impossible to not look at it and be captivating, right? It's
so the point
a
of this
5.5% rate, but then you look at the APR and you calculate the difference with the client. You're like, well, dude, you're paying $20,000-$30,000 to get that lower
That's
rate.
if they look that deep. But the point of this is the news is reporting on the averages. The averages are getting lower in the rate advertised because lenders have caught on to the idea of charging more fees, so the rate doesn't sound as high.
Overall average.
So the average sounds lower than what really rates actually are, which is critical. You got to not just jump at the first chance like, oh my gosh, rates are super low. I need to refi because, right now's the time the news said that rates are down. And we told you to refi when rates got to a certain point. It really, truly is not that simple.
Well, and if it made sense to pay all that money to get the lower rate, we would have had you do that at the time of purchase, not wait 6 to 12 months and then charge you all the fees again.
Exactly.
That's literally a lender just trying to make commissions.
100%. Really? Yeah, we would have suggested a rate buy down in the beginning. Those of you that work with us understand kind of our strategy in a sense. So you can't trust the media. You can't trust what social media says. You can't trust your friends and neighbors and colleagues that own a home but are not in the industry and experts, because timing the refinance and doing it the right way is multifaceted, very individual to your unique situation, what you're looking to accomplish, what's on your loan, so on and so forth. So we wanted to hit that first and foremost because I think a lot of people are chomping at the bit, super excited, and they're not they could make very bad decisions with predatory lenders who are encouraging them to do these refinances with obscene fees, and you can lose tens of thousands of dollars in either cash or equity in your home. Nonetheless, it's your money that you could lose, so you got to be cautious. So now diving into that,
now we calculate
break even.
Right.
We're really dumbing it down for you, so now you can shop for this stuff and figure it out. But the break even points, this is really actually what it boils down to
the whole refi.
Yeah. And I just do a cost over savings ratio. And that ratio, if it's over 1, that's too high, that ratio. Yeah. So talk about break even, how we handle that, and I can kind of put a cap on this simple terminology of cost over savings ratio.
Really how we calculate it is total cost minus or divided by your total monthly savings. And then we see how many months it takes to essentially recoup your investment or the cost of that refinance. And if it's within, I would say if it's less than a year, maybe it makes sense. If it's beyond that, it really doesn't, because there's a very slim chance that you're not refinancing at a much cheaper cost within that year period anyways. So the ultimate goal is that the monthly savings that you see, we are very likely to at least break even on that before we're actually in another opportunity to refinance again and save even more money. So that's how we calculate the refinance to whether or not it makes sense. It's a simple calculation that we all use every single time. We can get into some more math because
it's as simple as that. It's really what are the costs you're paying to get the refinance, the transactional cost. So what I mean by that is the costs you're paying as a result of the refi. So that doesn't include escrow, taxes, insurance, prepaid interest. It doesn't include that because those are things you're going to pay whether you do the refinance or not. So only these costs that are a result of the refinance. What are those? And then what are your monthly savings or annual savings, which is what I was referring to when I first introduced this idea before Ryan got talking. So monthly or annual savings. Let's just say monthly. If you take the cost divided by the monthly payment savings, and that is greater than 12, right now it doesn't make sense. So this is not a foolproof strategy saying if you break even in less than 12 months, you should do it. If it's more than 12 months, you shouldn't, because so much of this has to do with the dynamics of the market conditions. What's happening in the economy? What are the expectations for rates moving into the future? Because in my career, I've been in the business 16 years. There's many times I've told clients to refi, and it's a 3 or 4 year break even on the savings. But we refinance, back in the glory days, we refinanced. Rates were at 3%. So it's like,
as long as they're staying in the home, or they can foresee themselves staying in the home for that long, it makes sense.
Exactly. I was telling people to buy down to 2.25. Even one person, I told them to buy down to 1.9%. Why? They were going to be in that house forever. It was a significant buy down. It could be financed. They break even. They're going to hold the loan for 30 years.
Yeah, there's a time and a place for them.
Yeah,
but right 100%. Now, not so much.
Yep. So now dive into LLPAs, because this is something that's really kind of frustrating for us and a newer complex thing. Really. Like Fannie Mae, these LLPAs got really bad after the previous refinance boom. So during this period of time, as rates have been higher and no one's been refinancing, it's really not been noticed by most consumers and most industry people for that matter. because you haven't been paying attention to it. Yeah. But there were changes, very significant changes that Fannie Mae and Freddie Mac made.
It was a big deal. It was,
loans.
Everyone was talking about it for a while. It was the tax on the more qualified borrowers to make the overall costs for less qualified buyers cheaper. That's
so on a purchase standpoint, they basically gave people that had better credit and 20% down a worse rate than somebody with worse credit and 3% down, which is totally does not make sense.
Right.
Because it's all a risk. Loan level price adjustments is what it is. So that's like the risk metric for the lender.
And we should, if you want to follow along with this, you should just Google Fannie Mae loan level pricing adjustment matrix, and you'll see like it's a pretty complex matrix, but it'll show you like it'll have highlights of red, so areas where you're getting more loan level pricing adjustments, and green for cheaper costs. So it's
I know what you're talking. You're talking about that graph that was going around for a while.
Yeah. And I even have to pull it up often nowadays, just because it is a little complex.
Yeah.
So I would start there. You can get an idea on how
it'll give you a deeper understanding of what we're talking about.
Yeah, because it is pretty complex, but that plays a role in a lot of refinances. Like right now, I have a client. They're at 80% LTV. They have 730 FICO, and their rate, looking at it today with very minimal cost for it to make sense, is, just about what they were at 8 months ago when they bought, and rates were substantially worse today if we're looking at a purchase loan. So it's just those weird little things that you wouldn't know as a buyer or a homeowner that are definitely playing a role into the refinance and whether or not it makes sense.
And this is also playing a role into why lenders started charging discount fees to make up for these loan level price adjustments, so that they're giving you the par rate, if you will, but they're charging you for it, which is really a bad deal. So like, to give you an idea, I just pulled up the loan level price adjustments. So let's just look at a refi. You said this client was a 730 credit score.
730 credit, 80% LTV.
80%?
Yep.
Gosh dang, this is crazy. That client, 730 credit score, which is a good credit score. 80% LTV. They have 20% equity. That's a good loan. That's what so many people think you should have, because now you can get rid of PMI.
Very low risk.
Those people are getting loan level price adjustments. So a better way to explain this is they're getting costs, like discount costs charged to them, discount fees charged to them because of their supposed risk, where it's like, how risky is a 730 credit score at 80% loan to value? Not that risky, certainly less risky than a 690 FICO or credit score with 3% down. But these people are getting hit 1.75% discount points. So what was that loan? 500 grand probably?
Yeah.
Right around there. So get this, to get what the par rate would be if you were purchasing a home with 3% down, to get that same rate on a refinance now on that $500,000 property, they're paying almost $9,000 in discount fees just to get the rate that if you put 3% down as a first-time buyer, you could get with a purchase with no discount fees. It's insane. Yep. It's almost like to me, this is a little bit conspiracy theorist, and Ryan and I share some of these things with conspiracy theories, but this is almost like the agencies, Fannie Mae and Freddie Mac, are in cahoots with the banks because they don't want people refinancing too quick so the banks can make their interest on the loans that they funded in this high rate environment, because they're like disincentivizing refinances. And we know values have come up. We know, over the past several years, average credit scores on mortgages have been continually going up. Who's getting penalized? Lower loan to value, meaning values are appreciating, and higher credit score people, which is insane.
It's a whole nother layer that's factored into your refinance now, because if your equity has increased and you went from when putting 10% down a year ago, and now you're at 80% LTV because you've appreciated enough, well, your interest rate has now gotten worse.
By not a small amount. We're talking like, very significant. So that 1.75% in LLPAs, if you look at it on the rate sheet, is like the equivalent of a full percent in rate.
Yeah, it's a big
deal. Like if one person could get 6%, this person with the refinance that has all these LLPAs attached to it now is a 7% rate. It's like, that's insane. It's a huge deal. So I don't know. Hopefully the market adjusts and pricing changes where these loan level price adjustments become less damning on the rates themselves, even though the charge will still exist. Because as the market normalizes, there will be more pricing in the rates because the banks won't be so fearful of what's called prepayment risk, meaning you get a loan and the likelihood of you paying that loan off very quickly is high. And right now that's the case because of the market conditions and the fact that rates are on their way down. Everybody knows it, including the banks.
Yeah. We know our clients are wanting this refinance as soon as possible. I mean,
so do we.
So do we. Yeah.
It's how we
but
make
we
money.
Can't morally advise you to take these higher costs to get the lower rate because we know the math. We know how to calculate it. We're not going to willingly rip you off.
Oh my gosh. And that's the crazy thing about our industry. We say this all the time. It is such a low barrier to entry industry. The people that are advising on these loans, especially refis, because so many people just like they set up full companies to chase refis in these markets, they don't even know how to calculate the numbers, period. So they can't give you the right advice. It's not that they're being unethical.
To the used car salesman, like
right.
Just the worst of the worst salespeople out there.
Yeah, they're not advisors. They're just like, well, hang on, let me look at my book here. So it looks like, yep.
It's exactly what they do. Oh, we'll get you this payment. Oh, you want your payment lowered by $500? Okay, we'll get you there.
And you can get there.
But then they throw in $30,000 in fees, and they just expect you not to understand because most people that's going to go over their head. Oh, just sign there. Yeah, we're lowering your payment $500.
But at a cost of losing $30,000 of your wealth and your family's hard-earned money. Like
exactly,
you got to know the whole. So now that's a perfect dovetail right into like our strategy. So maybe share some things. I'll backfill with ways that I strategize with my clients. But like, how are you strategizing with your clients on when to do this?
Well, it's really seeing the rate that they're at when they purchased, and then we essentially put target rates in your, in your notes, and we do daily rate monitoring, part of our Client for Life policy, and we check it. Each day we see little pops in the market where we see improvements. We will go on, we'll manually review the loan, see if it's actually eligible for a refinance that does make sense, that doesn't charge you thousands in fees. And, at that point, we'll actually start to get it done. If it doesn't make sense, we'll let you know, and we'll keep continuing to keep an eye on it.
So we're not taking a predatory approach of like, oh man, there's definitely a way that I could sell this person and prey on the whatever it is that they need,
right,
despite the fees, just to close this deal. That's certainly not the approach we're taking. Every day we're looking at these manually, like with our own eyeballs, with our team. We meet around the conference table every day, and we do this for our clients.
We have systems too, but yeah,
we have technology that's backed on this as well, that's tracking every data point on our past clients, showing us when a refinance opportunity exists. Then we dive in. A couple other things I like to talk about is right now, a big thing for many people is consolidating debt or getting other debt paid off because the fact, credit card debt just hit another new record just like last week.
Yeah.
We're at like almost 1.2 trillion. If you go back a few episodes, I don't know, it's maybe been 6 or 9 months, something like that. We had just hit $1 trillion in credit card debt. So we've literally added 20% in additional credit card, 15 to 20% in additional credit card debt for families in a matter of 6 to 9 months. Things are spiraling out of control, and we understand that. Now, again, going back to some lenders that may not understand how to coach properly through these options. And the beauty is we've helped more than 5,000 people buy and finance real estate. Like we know this stuff. The more reps you have, the stronger you are. That's just the fact of the matter in any industry, in fitness, whatever it is. That is what we're good at. We can run these numbers for you. But when you're
talking something more so like a blended rate with your total consumer debts and
that might be an important
those
factor. But then you might talk to a lender and like, oh, you can't do a cash out refinance because you can't consolidate any debt because you don't have enough equity. You don't have 80% equity, and so you can't do a cash out because cash out refinances are limited to 80% unless it's a VA loan. Well, if you're logical and smart about this, you can structure what I phrase as a mini cash out. So you actually get better terms. You're not paying again, there's loan level price adjustments where the loan is more expensive because it's a cash out loan versus a no cash out loan.
Yep.
So I structure like mini cash out refis. So what you can do on a refinance is you can structure it where you skip 2 monthly payments on your current mortgage. So let's just use an example. You have a $3,000 mortgage right now. We structure it just so, and there's of course no late payments or anything like that. You skip 2 monthly payments based on the strategy when we close, when we time it, the sequence of it. You skip 2 monthly payments. So that's $6,000. Then we can finance your new escrow account into the new loan, and you could get a refund from the current escrow account. let's just say, for example, that's $2,500 sitting in escrow, which is a decent average.
Yep.
So now we're $6,000 plus $2,500. We got $8,500 sitting in there. Now, as a no cash out refi, we can get you up to $2,000 cash back in your pocket from the proceeds of the loan, and it's not considered a cash out. So you get the best possible rates, but you also get a little cash. So we're talking $2,000 plus $2,500 is $4,500 plus $6,000 in skip payments. We just got you $10,500 as a mini cash out to either fund home improvements or consolidate debt. And I mean, we look at people all the time, their credit profiles, and $10,000 in debt could easily be somewhere between $400 and $1,000 a month in payments.
Exactly. So even if you're only saving $100 on the mortgage payment on the refi itself, if you're actually taking that cash and utilizing it how you should, how we planned, freeing up another 4 or 5, I mean, up to thousands.
Right. Just
now
depends on how
that becomes an $1,100 savings.
Yeah, exactly. So you could either pocket those savings, or you could, just keep making the same payment you were previously making if it was easy to afford, and you pay your house off, 5, 10, 15 years sooner than you otherwise would. Like, there are so many creative ways that you can capitalize on mortgage financing as a holistic financial strategy for whatever in the heck you need to accomplish. Like, it's way cheaper than going to get a HELOC. As far as rates are concerned and overall costs, it's way cheaper than getting a home improvement loan. It's often way cheaper than getting an auto loan. Now, granted, you're paying for a longer period of time on a mortgage. However, something that many people miss, you can prepay and pay off that balance faster. So you could pay the same amount as if you were paying a car loan and drive your mortgage balance down. So you're actually making money by doing it. But it's also potentially tax deductible. So if you can finance other things inside of a mortgage, that mortgage interest is tax deductible. Student loan interest is not. Credit card interest is not. Auto loan interest is not. It's crazy. Home improvement loans are not. So anyway, and we're just trying to, we can only scratch the surface on the stuff that we dive into. I mean, we are creative SOBs. We figure this stuff out and we understand what your goals are before we start advising. And then we advise with a holistic strategy that's going to get you to a place where you reach those goals. Now, our Client for Life program, talk about that, because this is something super cool. Lots of people have actually tried to copy. Our competitors in the marketplace have kind of caught on to this and tried to copy us, but talk about all that's encumbered in our Client for Life program.
Yeah, well, it's daily rate monitoring. We also have repeat client incentives, so we're waiving our lender fees anytime you come back to purchase or refinance with us. So that's going to save you a ton of costs as well. But the biggest thing is you don't have to stress about the news media telling you interest rates are coming down, or the billboard that you drove by and wonder if it makes sense to refinance. We're taking that burden for you, and we're giving you those repeat incentives when you come back.
Yep. So you've got an advisor looking out for your best interest. It's what we do all day, every day. It's very important for us to take care of our clients. We're watching this stuff both manually and backed by technology, so we can't. There's no human error involved. We see it constantly, so that's huge. No lenders are doing that, except for the ones that are preying on you and the vulnerability to get a refinance and probably not giving you the right advice, which goes into the third piece, which is you can rely on consistent, proven strategies and advice. I mean, you look us up online, we have hundreds of 5-star reviews. We've been in the business forever. Like, we are a proven team. So you get all that, plus we waive our fees as the lender. You don't pay underwriting fees, processing fees, origination points, none of that crap. You don't pay any of that stuff as a repeat client of our team. So you do one loan, forever and always, you don't pay that stuff. So not only are we advising not to pay these discount fees, but we're also not charging you any fees, any lender fees, basically at all. So these are huge incentives.
One of the cool thing is you have access to us as resources all the time. You don't have to be transacting.
Which actually doesn't cost you any money, which is crazy. Like, we
sure.
only get paid when a deal closes. So our advice basically comes for free from the clients that trust us and know us, and help you guys make decisions, help you overall create wealth for you and your family long term. So moral of the story, don't refinance too soon. Don't get sucked into the media drama. Lean on experts, lean on advisors. We would love to be that for you. You can hit us up. Our information's all over social media. Best way to reach us is on the team phone number, which is 801-713-4000. But we would love to help you, give you some advice, and coach you on the best strategy moving forward. One thing I did want to mention, sorry, this is kind of a PS. We didn't go into the strategy. So many clients are like, well, why would I refinance now So this is kind of our argument to potentially refinancing sooner than you may think.
Oh, yeah, okay.
Why would I refinance now and not wait for rates to come down if you're telling me rates are going to continue falling? Well, the reality is, if you look at it, if you can structure a loan where you refinance now and you save somewhere between 0.5 point and a point to refi, it's not going to be outrageous amounts of savings. It's not going to be the savings you ultimately want. But if you can lock in savings without paying anything for it, because there are ways to get a cost-free refinance, meaning you don't pay any third-party fees either. And if we can get you a loan that is valuable and save you a couple $100 a month, but the break-even time is 0, meaning you've made your money back before, as soon as you close the loan, because you didn't pay any fees for it,
or even
and you
3
skipped a payment.
months, 3 to 6 months, even on the shorter term.
Right. You should capitalize on that because it's like trying to catch a falling knife. When's the best time to grab? I don't know, never, right? But you want to capitalize those savings because what if things reverse and rates spike back up for another 6 months? Okay, so you just wasted $200 a month that you could save today for 6 more months to wait for rates to get back down to where they are today, right? So capitalizing strategically on locking in savings now and then stepping your way down on the rates, that's where our expertise comes in and our market knowledge comes in. And then at some point when we feel like we've hit the terminal low point on the mortgage rates, then we might change our tune and say, hey, let's buy your rate down. And, say rates are at 4.875 with no buy down sometime in the future. We would say, hey, let's buy your rate down to 3.99. Now we know you're never going to touch that mortgage again. It's a long-term property. You may keep it for a rental, whatever. Buy down at that point. The break-even time might be longer. But now you've got a loan that you're going to be in for 10, 15, 30 years, whatever it is. So these
the strategy is
will
to
evolve.
keep it low cost while we know we still have room for rates to come down.
Yep.
Low to no cost in some cases. And then we've always told our clients when there's points in the market where we feel like we've hit a low point or more of a consistent point, let's say like 5s. I don't know if we really go much lower than that. If we hit that point, I think that's where you start to look into investing some additional cash if you're going to be in the house for long enough for it to make sense. And it all just goes back to the break-even points.
Yep. Anyway, thanks for tuning in. Hit us up if we can help. We would love the opportunity to help you. No strings attached. We can give you advice. If you decide to move forward, awesome. We'd love to be the lender for you. If not, you get free advice and have better decision-making capabilities. So thanks for tuning in. We'll catch you next time.
Sweet.
Thank you for tuning in. For more industry insights, follow us on all platforms at Loans Elevated.
And to get in touch with our team, call or text 801-713-4000 or visit loanselevated.com.